If you're looking for a strategy that can make you a living from day trading, in this video, I'm going to show you the exact trading strategy that has made me hundreds of thousands of dollars, and I'm going to show you how to identify trades using it so you too can make money. And if you do find value in this video, make sure you are subscribed to the channel because I do put a lot of time and effort into these videos. But let's hop into it. So the strategy that we're going to be discussing today is my Fibonacci trading strategy. Now, when it comes to trading with Fibonacci, there are many rules that I like to look for before entering the trade and making sure that I have the highest probability of having a successful trade. So my first rule is I need to see an impulse move. An impulse move is going to be an aggressive move in one direction, whether it be to the upside or to the downside. And for this impulse move, it needs to be a very direct move to the upside or downside. I don't like to see price trading all over the place and then make the move up or the move down. Now, with this impulse move, we can find this on multiple time frames. So now let's head on over to a chart and I'll show you exactly what an impulse move looks like. So looking at ES on the 5-minute time frame, here are two examples of an impulse move. This one is going to be the upside. You can see that this was a very quick, very direct move to the upside. We didn't have a lot of chop before making this move up. It was just one strong move to the upside. So that's going to classify as an impulse move. Now, another example of an impulse move, but this time to the downside, was this very sharp and quick sell-off down. Again, notice we didn't have a lot of chop in this range before dropping down. It was just a very quick move from up here all the way down here. So when looking to use your Fibonacci retracements, you need to identify that impulse move. Now, rule number 2, you need to look and determine what is the overall trend based off of this impulse move. If the overall trend is to the upside and we make a very strong impulsive move up, then we know that we want to use the fibs for a bounce. However, if we're in a strong uptrend and price makes a strong aggressive move to the downside, taking a reject is going to be a lot higher risk because the overall trend is to the upside. So being able to determine the trend allows us to identify if we're going to be looking for a bounce or for a reject. And the same goes for a stock that's in a strong downtrend. If it were to make a quick aggressive move to the upside, we don't really want to use Fibonacci to start looking for bounces. Instead, we want to look for retracements to take rejects and then catch the next leg down. So now heading back on over to the chart, I know I showed you guys this impulse move here. However, I wouldn't necessarily like to use this to look for a reject because the market has been so strong recently. Instead, I would be looking for the impulse moves to the upside to then catch a bounce when price retraces. So again, you need to understand what the overall trend is before you start using your retracements, whether it be to the upside or to the downside. And something that I've noticed, which is why I don't do it anymore, but if the market's in a strong uptrend, I'm not looking for those rejects because one, they're going to be significantly higher risk. But second off, I took a lot of losing trades doing so. So trust me when I say this, understand the overall trend and trade with the trend. Now, rule number 3, you have to mark the retracements. If price is in an uptrend and you have that strong impulsive move to the upside, you're going to be looking for a bounce. And now what you're going to do is find the low of that impulse move and the high of that impulse move, and you're going to mark it using your Fibonacci retracements. So heading back on over to this example right here, this was the low of that impulsive move up, and this was the high of that impulsive move up. So as a result, we would take the low of this impulse move to the high of this impulse move, and we would want to look for price to trade back to that 50 or 61.8. And as you can see, price hit that 50% retracement, made it support, and had a nice little push to the upside, which could have been a profitable position. We're looking at NQ on the daily time frame. This was the low before a strong impulsive move up. This was the high before price started pulling back. As a result, we would take the low of this impulse move to the high of this impulse move and look for price to trade back to the 50 or 61.8% retracement. Now, if price is in a strong downtrend, we want to start looking for rejects, and what we're going to do is we are going to identify the high before price made the strong impulsive move down to the low of that impulse move, and then we're going to draw our retracements from the high to low and watch as price retraces back to the 50 and 61.8 for a potential reject. Looking at NQ on the daily time frame, we have this high point right here before a strong aggressive move down. So as a result, we would take our Fibonacci retracements, mark it from the high to the low, and look for price to trade back up towards the 50 and 61.8% retracement to then look for a reject for the next leg down. So now that you know how to mark the retracements, let's discuss entry criteria. Rule number 4 is going to be entries. So when price is trading at a bounce level on your Fibonacci retracements, you want to look for bullish price action. Bullish hammers, bullish engulfing, dragonfly dojis, long lower wicks into the fib level. This shows us that buyers are interested in that area and are more than likely entering the market looking for a move up. Now for rejects, we want to look for bearish price action. So if the overall trend is to the downside and price trades back up into your retracement, you want to start looking for bearish price action. Bearish hammers, gravestone dojis, bearish engulfing candlesticks, or even long upper wicks, because that's going to show us that sellers are entering the market and are looking for price to continue going lower. And along with the price action, you also want to look for volume confirmation. If there's heavy volume at the bounce level and you have bullish candlesticks, this is showing us that buyers are having orders filled and are more than likely looking for that move up. Or if price is coming up to reject a fib, we see bearish price action and very heavy bearish volume. That's showing us that sellers are entering the market and looking for price to continue lower. So again, when price is trading at the fib, look for confirming price action, look for confirming volume, because that's going to make the trade a lot higher probability. And in a little bit, we're going to look at trades that I've actually taken using Fibonacci retracements. That way you know exactly what to look for when it comes to your entry. Now, rule number 5 are exit points. Typically, I will look to exit the position if price starts to break on the opposite side of the fib, because if price is truly making a retracement, it's going to react at those fib levels. And if it starts breaking on the opposite side, it's more than likely not a retracement and it's going to continue to go in that direction. So an immediate exit for me is if price starts to break on the opposite side of the fib and show strength on the opposite side. Now, as far as day trading actual stocks, I like to put my stop loss around 20 to 30 cents on the opposite side of the fib. And then if you're trading futures, around a few points on ES, NQ, you're going to have to give it a little more than, a couple few points because NQ moves a lot more, but it really depends on what instrument you are trading. I've just found that 20 to 30 cents on stocks is a really good area for stop losses. ES, again, a couple to a few points, but NQ, I'd probably give it like 10, 15 points on the opposite side of the fib just because of how much NQ moves. So going back to the ES example that I showed you guys earlier, looking at the bounce, as we see price reacted off of the 50% retracement. So if I were to get long at this point, I'd put my stop loss probably around like 49.22 to 49.21.5. Or if price reacted off the 61.8 and confirmed an entry, again, I'd do the same points, maybe give it around a couple points to the downside for a stop loss. And then here are some other rules that I like to look for before entering the position. First, you need to wait for a candle close. I see a lot of people enter the position prematurely before the candle closes, and it just completely invalidates the trade and stops them out. So wait for that candle to close to give you proper confirmation, and once it does, that's when you can enter. Second, and I can't stress this one enough, is going to be heavy volume. Again, if there's heavy volume at the fib, that is showing that orders are being filled and makes the trade a lot higher probability. And then third, as always, we need confirming price action. If these 3 things are present along with everything else I've shown so far in this video, that sets up for a high probability trade. And again, your stop loss is going to be very tight because if it invalidates the fib, you know the trade's invalid, you get out and you move on to the next one. So now let's look at some actual real trades I have taken using Fibonacci retracements. All right, so now looking at some trades that I have taken using this exact trading strategy that I just shared with you guys. The first one is going to be on QQQ. So looking at QQQ, this is on a lower time frame. This was just a 3-minute time frame setup. But looking at it, we had this low right here, very quick impulsive move to the upside. I marked the pivot low to pivot high, was looking for price to trade back into the 50 or 61.8% retracement. As we see, we did pull back to that 50% retracement. You could have started your position there. But if I remember this trade correctly, this is when I entered because as we see, price pulled back to that 61.8% retracement, broke below it, reclaimed it on very heavy volume, which again, that meets the exact criteria I would look for to enter long. And my stop loss was 20 to 30 cents below this low point right here. And I was able to catch a beautiful move to the upside on this QQQ trade. Here's another example of a trade on SPY that I took. However, this time to the downside. As we can see, I marked it using a higher time frame fib, so it was actually like a 15-minute fib. But we had this high point right here to this low point right here. And typically when I'm looking to enter at these fib levels, I'm using a 2-minute or a 1-minute time frame. And as we can see, as price trades up into that 61.8% retracement, look at how heavy that volume was on the 1-minute candle. This volume was heavier than the opening 1-minute candle, which confirmed the entry short, and my stop loss was if price started breaking above this high right here. As we see from there, price continued to sell off and went into a new low of day. Here's another example, but to the downside on QQQ, we have this high point right here, very quick aggressive move to the downside, marking pivot high to pivot low. I was looking for price to retrace back up into the 50 and 61.8% retracement. As you can see, once price hit that 61.8, or pretty much came right up to the 61.8, it was a smaller candle, but heavier volume than these previous two candles right here. What does that tell us? Sell orders are being hit in this area. As a result, I got short, my stop loss being above this 61.8% retracement, and was able to catch a beautiful move down. And then looking at one more example to the upside, this one being on SPY. This was a higher time frame fib level, and I actually had two of them in the same exact area. But as you can see, price held that 50% retracement, eventually broke below it, but as price got down to where these two retracements were, the 50 and 61.8, what do we notice when price hit the fib? Heavier volume here, heavier volume here, confirming a move to the upside with a stop loss right below this low. That's going to wrap up this video, and hopefully you guys did find a lot of value in this video. If you did, it would mean the absolute world to me if you guys did hit that like button, as well as subscribing to the channel. Again, I spent a lot of time making these videos for you guys, so hopefully you are finding a lot of value in them. Other than that, everybody have an amazing rest of your day, and I'll see you guys in the next video.